Wall Street has closed an amazing November in a bullish mood, according to some analysts, and for good reasons too. Increasingly, cooling inflation data and strong Salesforce earnings contributed to fueling serious momentum in equities. The Dow jumped 500 points to a new 2023 high on Thursday. All in all, a 9% rally in November alone. Now, the software company Salesforce popped 9.4% on the back of better than expected earnings and revenue for the fiscal third quarter. And personal consumption expenditure, the Fed's favourite gauge of inflation, slowed further to 3.5% on a year-over-year basis. All of this caused traders to conclude the Federal Reserve is likely done raising rates and could even begin lowering them in 2024. Potential future cuts in rates led to dollar weakness, with the euro, pound, yen, Swiss franc all hitting multi-month highs against the greenback, bringing some relief after a strong dollar trend in the previous months. Meanwhile, oil prices have been on a bearish trajectory as driven by bearish sentiment on the supply side, despite geopolitical tensions. But they're expected to rise in the new year and even hit $100 a barrel, after some OPEC Plus oil producers voluntarily pledged to cut output. Well, for more on this, let's go to Bob Iacchino. He's the founder of Path Trading Partners, and he joins us now from Miami. Really good to have you with us, Bob. Can we start by reflecting on the November that was, a November surprise, so to speak, because few people saw this rally on Wall Street coming. We saw the S&P 500, for example, having one of its biggest gains so far this century, in fact. Some estimate it to be worth around $3 trillion. Explain to us more about why we saw this remarkable rally on Wall Street.
Well, it's good to see you again. The first thing you can look at is what was happening in the previous months, where we saw a fairly significant decline off of the rally from the previous October's lows. So that previous October's lows seemed to be reaching up towards starting a new bull market, making new highs, and then we basically had a 3-month sell-off. Now, if you look at November historically, it is historically the strongest month for equities across the board. So coming off of a 3-month drop in equities, it made sense that November would be a good month to rebound. You add to that the 50 basis points of drops in yields. If you go to the 2-year, it was 34 basis points, 50 basis points in the 10-year, 50 basis points in the 30-year. That's a full 0.5% drop in Treasury yields, which, as you mentioned in the previous comments, right now the market is not only pricing in rate cuts in 2024, but they're pricing in right now 125 basis points or 1.25% in rate cuts through the full year. Now, Fed officials are pushing back against that. We saw that from San Francisco Fed President Mary Daly yesterday. We saw it from Richmond Fed President Thomas Barkin on Wednesday. They're pushing back against that narrative. They're warning of potential rate hikes to come, but more strongly, they're saying that rate cuts are not in the picture. The market clearly doesn't believe them. The market is a forward pricing mechanism. And as you mentioned, when you see inflation continuing to decline, and by the way, I need to mention, this does not mean prices are going down. It means the rate that prices are increasing is slowing. So if you look at, for example, the overall CPI index, it's exactly that. It's an index, and it has not fallen at all. It's just risen at a slower trajectory. So based off of that, markets seem to believe that the Fed at some point will pivot and start talking about the potential for rate cuts. I'm not sure if I agree with that at this point.
And that's exactly what I wanted to ask you about, because as you say, the market is pricing in rate cuts, which would be a remarkable turnaround from the aggressive rate hike campaign that the Fed has embarked on for the better part of a year at least. Is it too optimistic, do you think, for the market to expect them to really do a sharp about face and start slashing rates?
Well, first of all, I have to say that I am long stocks because regardless of what I think the Fed may do or what I think the Fed should do, I'm an active investor, so I need to be involved in what the trends are. And clearly the trend is higher right now. We've got December, the Santa Claus rally. There's some people that are saying the Santa Claus rally happened in November. I think it's likely to continue, although much weaker than November, through the end of the month. But having said that, I agree with you, the basis of your question, the thesis of your question, that it is too optimistic. And the reason I say that is because when you look at productivity growth, output, and wage growth, along with consumer spending, you look at a 60% services economy in terms of consumer spending. Consumers spend a full 60% on services, and services inflation is still running above 5%, regardless of which metric you look at. The most important one, services X energy, sat at about 5.3% on a 3-month annualized basis. And then you look at wage growth, still above 5%. That's not consistent with services inflation coming off at all. Maybe a tenth of a percent, 0.2%. It's clearly going to be above 5.5 or 4.5 or 4.7% going into 2024. And so when you look at that, that's 60% of what the consumer spends their wages on. So there's no relief there. Number two, when you look at the overall trajectory of the labor numbers, unemployment is still below 4%. Initial jobless claims that comes out every week in the US is still in the low 200,000. That's not indicative of consumers losing their jobs. And Americans tend to act the same way their government does. They spend money even when they don't have it. You saw that in the Black Friday and the Cyber Monday numbers when you saw that buy now, pay later, which of course is a form of credit, was up 72% from the previous year. So consumers are buying on credit because they're not losing their jobs. So they believe they'll be able to pay those bills. If they start to lose their jobs, that's more likely to spur the Fed to potentially consider rate cuts. It's not going to happen until we see that, and we haven't seen it in very large numbers at all.